Right now, at this exact moment, while you are watching this video, Wall Street computers are executing a crime so brazen, so mathematically documented, and so deliberately invisible to mainstream financial media that most investors will not understand what happened to their wealth until it is already gone. Silver should be trading above $100 this morning. Every geopolitical signal, every physical demand indicator, every historical precedent from every major monetary crisis of the last 50 years is screaming that number. Instead, you are looking at 97.83 on your screen and wondering why the market is not making sense. It is making perfect sense. You just have not been given the framework to read it correctly. Yet. Stay with me because what I'm about to walk you through in the next few minutes will permanently change how you see every price you ever read on a financial screen for the rest of your investing life. Let me tell you exactly what happened this morning and why it should make every serious investor stop and pay attention. Silver closed Friday at 93.66. Asian markets opened Sunday night into Monday morning with full knowledge of what Operation Epic Fury meant for global supply chains. Oil tankers were rerouting. Shipping insurance premiums had exploded by 400% overnight. Geopolitical analysts were using language on mainstream television that nobody had heard since the Cold War era. The rational, logical, historically supported response to that environment was exactly what we saw. Shanghai started bidding aggressively. Hong Kong wealth managers were making calls at 2 a.m, trying to secure physical silver allocation before Western markets even opened their eyes. Every single historical precedent supported what should have happened next. In 1973, during the Arab oil embargo, precious metals surged violently as investors recognized that paper currency could not protect them from geopolitical shock. In 1979, as Iranian crisis unfolded and inflation spiraled, silver moved from single digits to $50 in months. In 2020, when COVID shattered global supply chains, physical demand exploded even as paper prices temporarily collapsed. The pattern is documented, consistent, and undeniable. By every law of supply and demand, silver should have crossed $100 this morning and kept moving. The geopolitical catalyst was real. The physical demand was real. The supply disruption was real. Everything that historically drives precious metals to explosive price discovery was present and active simultaneously on a Monday morning when rational capital was desperately searching for a safe harbor. Instead, at 9:30 a.m. Eastern, something else entirely happened. The price did not rise. It got hammered to 97.83 right before New York opened for business. Not because supply suddenly appeared, not because demand collapsed, not because the geopolitical situation improved overnight. The price dropped because algorithms executed a strategy that had nothing to do with actual market fundamentals, and everything to do with protecting institutional short positions that were staring at catastrophic losses. That is the critical detail that most retail investors completely miss in real time. When a price drops during conditions that should send it higher, that is not the market speaking. That is intervention. And understanding the difference between a genuine price signal and a manufactured one is the single most important skill any serious investor can develop in today's financial environment. Most people watching silver this morning saw a price drop and assumed the market was speaking. It was not. What they actually witnessed was one of the most documented, repeatable, and legally prosecuted forms of financial fraud operating in broad daylight inside the world's largest commodity exchange. Here is the mechanism you need to understand. The bullion banks, the major institutional players running massive short positions on silver for years, were staring at a Monday morning that threatened to destroy them financially. Physical demand from Asia had gone parabolic over the weekend. Their short positions, bets that silver would stay suppressed, were facing unlimited losses as the price pushed aggressively toward that $100 psychological barrier. In a genuinely free market, those banks would have two honest options. Either buy physical silver to cover their short positions, which would push the price even higher, or absorb the loss and move forward. Neither of those options happened. Instead, they printed silver. Not physically. Not from any mine or refinery. They created naked short contracts, paper promises to deliver silver that does not exist in any vault on planet Earth. This morning, in the minutes before the New York Open, algorithms unleashed the equivalent of hundreds of millions of ounces of these fake contracts into the futures market. To understand the scale of that, global silver mining produces approximately 1 billion ounces per year. They dumped the equivalent of nearly a third of annual global production onto the market in minutes. That is not supply. That is manufactured illusion designed to trigger stop-loss orders, terrorize retail investors, and prevent a price breakout that would rewrite the entire financial narrative. This strategy has a name. It is called spoofing. It is illegal under the Dodd-Frank Act. It leaves a specific, identifiable fingerprint on the charts that any experienced market analyst can recognize immediately. And it is not theoretical. JP Morgan was fined $920 million by the Department of Justice in 2020 for executing this exact strategy in the precious metals market. Their own traders were prosecuted under racketeering statutes typically reserved for organized crime. The evidence was overwhelming and the conviction was real. What makes this morning particularly significant is not just that the crime happened again, it is that it happened under conditions so extreme, with geopolitical pressure so visible and physical demand so undeniable, that the manipulation required was larger, more aggressive, and more desperate than anything seen in recent memory. Here is what the bullion banks fundamentally miscalculated this morning. And this is the part that changes everything for anyone paying attention to the physical market data rather than the paper price on their brokerage screen. They can print paper contracts indefinitely. Their algorithms can dump the equivalent of hundreds of millions of fake ounces into the futures market in milliseconds. They can suppress the New York spot price to $97, to $95, to whatever number their models determine will cause maximum psychological damage to Western retail investors. That capability is real, and they are exercising it right now. But there is one thing they absolutely cannot do. They cannot print physical metal. They cannot conjure actual silver bars into existence and ship them to Shanghai. They cannot fabricate real ounces and deliver them to the vaults in Mumbai that are desperately seeking allocation this week. The paper world and the physical world are operating on completely different realities right now, and that divergence is the most important financial signal of 2026. The Shanghai Gold Exchange, the largest physically settled precious metals exchange on the planet, is currently running a premium of over $4 per ounce above the COMEX spot price. That means Chinese buyers are willingly paying $4 more per ounce than the price Wall Street's algorithms are advertising. They are not doing that because they enjoy overpaying. They are doing it because the physical metal is genuinely scarce, and they understand that the New York paper price is fiction. In India, the world's second largest silver consumer, premiums are running $6 to $8 over spot because supply chain disruptions from Operation Epic Fury have created a physical shortage that exists completely independent of whatever number the COMEX computers are currently displaying. That spread between paper price and physical reality is the fracture line in the entire system. Every single day that Wall Street holds the paper price artificially below fair value while the physical world burns is another day that Eastern buyers exploit that discount with absolute aggression. Chinese state enterprises are draining COMEX-registered vaults at a pace that the withdrawal data makes impossible to ignore. Every ounce leaving those vaults and crossing the Pacific is an ounce that will not be available to settle a futures contract next month. The COMEX currently holds approximately 453 million ounces in registered vaults against open interest obligations, representing over 900 million ounces. That is a system selling the same ounce twice. And the Eastern buyers know exactly what that math means for what comes next. To understand why silver is being suppressed this morning with such desperation, you need to understand the 55-year financial architecture that makes this manipulation not just profitable for the banks, but existentially necessary for the entire dollar system. Because this is not simply about silver, this is about the credibility of the global reserve currency itself. In 1971, Richard Nixon closed the gold window. That single decision severed the last physical constraint on American monetary policy and handed the Federal Reserve the ability to create currency with zero limitations. The consequences of that decision have been compounding ever since. Your purchasing power measured in silver terms has lost approximately 98% of its 1971 value. That is not an opinion. That is arithmetic applied to publicly available Federal Reserve data. The dollar has been dying slowly for over half a century, and the financial establishment has deployed increasingly sophisticated mechanisms to disguise that death from the general public. What followed was a 55-year sequence of escalating interventions, each crisis requiring a larger, more aggressive monetary response than the last. In 2008, when Lehman Brothers collapsed and the overnight repo market seized completely, the Fed expanded its balance sheet from $800 billion to $4.5 trillion over 6 years. That was described as a temporary emergency measure. It was never reversed. In 2020, when COVID shattered global supply chains and triggered another liquidity crisis, the balance sheet exploded from $4 trillion to $9 trillion in months. This time, they did not even maintain the pretense of reversal. And in 2023, when Silicon Valley Bank, First Republic, and Signature Bank collapsed within days of each other, the Fed quietly injected another $2 trillion through the Bank Term Funding Program without a single mainstream headline capturing the true scale of what had just happened. Each of these interventions transferred wealth from ordinary savers holding dollar-denominated assets to the institutions closest to the money printer. Each one debased the currency further, and each one made the next crisis more severe because the underlying mathematical insolvency was never addressed. It was simply papered over with freshly created currency. By 2024, foreign central banks had seen enough. China, Russia, India, Saudi Arabia, Turkey, Poland, and Singapore all began dumping U.S. treasuries and accumulating physical gold at levels not seen since the 1970s. That was not a coincidence. That was a coordinated recognition by the world's largest economies that the dollar's reserve currency status was entering its terminal phase. And silver, historically, has always been the leverage signal that this transition is accelerating. There is a number that every serious precious metals investor needs to understand right now. And once you see it clearly, the entire picture of where silver is heading becomes impossible to ignore. The gold to silver ratio is currently sitting at approximately 93 to 1. That means it takes 93 ounces of silver to purchase a single ounce of gold. That single data point tells you more about the current opportunity in silver than any chart pattern, any technical indicator, or any analyst price target circulating on financial media right now. The historical average of that ratio is 15 to 1. The ratio of silver to gold that actually exists in the Earth's crust is 17 to 1. Those numbers represent what the market looks like when it is functioning with genuine price discovery, when physical reality rather than algorithmic manipulation is determining relative value. The current ratio of 93 to 1 represents a deviation from historical norms so extreme that it has only occurred a handful of times in modern financial history. And every single time it has reached these levels, the subsequent reversion has been violent, rapid, and enormously profitable for anyone positioned in physical silver before the move began. But the ratio argument alone does not capture the full magnitude of what silver represents in 2026, because silver is not simply a monetary metal competing with gold for safe haven capital. It is simultaneously the most critical industrial commodity in the global energy transition. Every solar panel requires silver. Every electric vehicle requires silver. Every 5G antenna, every AI server farm, every advanced military application being deployed right now across multiple active conflict zones requires silver. You cannot substitute around it. You cannot engineer it out of these applications with current technology, and you absolutely cannot print it. The Silver Institute's own data shows that global silver demand has exceeded global mining supply by over 200 million ounces annually since 2021. That deficit is being filled by above-ground stockpiles that are being systematically consumed. The industrial demand alone would be sufficient to drive a significant price revaluation. Combined with the monetary demand from investors globally recognizing the dollar's deteriorating credibility and the supply constraints from Operation Epic Fury disrupting mining and refining operations across multiple continents simultaneously, the fundamental case for silver at current prices is arguably the strongest it has been at any point in the last 4 decades. If silver simply reverts to its historical mean ratio against gold at current gold prices, the mathematical price target exceeds $200 per ounce. That is not speculation. That is ratio arithmetic applied to publicly available market data. There is a moment in every major financial crisis where the gap between what the system claims is true and what is actually true becomes too wide to bridge. We are approaching that moment in the silver market right now, and the specific mechanism that will force that reckoning has a name, a legal definition, and a documented historical precedent that every serious investor needs to understand before March delivery closes. The COMEX is operating a fractional reserve system on physical silver. That statement is not hyperbole. It is a mathematical description of publicly available CME Group data. As of last Friday, registered COMEX vaults held approximately 453 million ounces of silver available for delivery. The open interest in silver futures contracts simultaneously represents obligations to deliver over 900 million ounces. That is the same ounce sold twice before accounting for ETF holdings, derivative collateral pledges, and competing legal claims from multiple counterparties on the same physical bars. When those factors are incorporated, the actual deliverable inventory against outstanding obligations likely represents a ratio closer to 4 to 1. The exchange has sold 4 promises for every 1 ounce it can physically deliver. This system functions only under one critical assumption, that the vast majority of futures contract holders will never simultaneously demand physical delivery, that they will either settle in cash or roll their positions forward into the next contract month indefinitely. For decades, that assumption held because Western investors were conditioned to treat paper silver as functionally equivalent to physical silver. That conditioning is breaking down in real time as Eastern buyers with completely different cultural and institutional relationships to physical metal enter the market with unprecedented scale and aggression. When a futures contract holder demands physical delivery and the exchange cannot provide the metal, the legal term for that event is force majeure. It is a default. It is the moment the fractional reserve illusion collapses and physical reality reasserts itself with consequences that paper holders are completely unprepared to absorb. Every unallocated silver account, every SLV share, every paper ETF holding becomes a legal claim against an insolvent counterparty. Legal claims against insolvent counterparties have a well-documented historical value. That value is zero. The people who will preserve their wealth through this transition are exclusively those holding physical metal with specific bar numbers and serial numbers assigned to fully allocated segregated accounts. Every other form of silver ownership is a sophisticated variation of an unsecured creditor position in a bankruptcy that has not yet been formally declared but is already mathematically inevitable based on the vault data available today. Pay close attention to what is happening on the eastern side of the Pacific right now because the most important silver market in the world is not in New York. It never was. And the divergence between what Asian physical markets are telling you and what the COMEX algorithms are advertising has reached a level that makes the manipulation impossible to rationalize with any legitimate market explanation. The Shanghai Gold Exchange operates on a fundamentally different principle than the COMEX. Every contract settled on the Shanghai Exchange requires actual physical metal backing. There are no naked short contracts. There are no paper promises to deliver silver that exists only in a computer. When a contract settles in Shanghai, real metal moves between real vaults. That structural difference is precisely why the Shanghai Premium is the single most honest price signal available in the global silver market today. And right now, that premium is running at over $4 per ounce, above the fraudulent COMEX spot price. Chinese institutional buyers are voluntarily paying $4 more per ounce than the New York computers are advertising because they understand that the New York price is a manufactured number with no connection to physical supply and demand reality. India is telling the same story with even greater urgency. As the world's second largest silver-consuming nation, Indian demand is driven by a combination of industrial consumption, jewelry fabrication, and deep cultural accumulation patterns that have persisted across centuries of monetary system changes. Indian buyers have survived currency collapses, colonial monetary systems, partition, and multiple fiat currency crises. They understand intrinsically what Western investors are only beginning to learn: that physical metal is the only form of wealth that requires no counterparty to maintain its value. Current premiums in Indian physical markets are running $6 to $8 over COMEX spot, reflecting supply chain disruptions from Operation Epic Fury that have nothing to do with paper price signals and everything to do with genuine physical scarcity in the real world. What makes this premium divergence historically significant is the direction of capital flow it is generating. Every dollar of premium that Asian buyers are willing to pay above the fake Western paper price is a signal to arbitrageurs globally that physical metal should be moving eastward, and it is moving eastward. The COMEX vault withdrawal data confirms it with numbers that are accelerating week over week. That metal is not coming back. Once it crosses the Pacific and enters the Shanghai or Mumbai physical distribution networks, it is permanently removed from the Western fractional reserve system that depends on its presence to maintain the illusion of solvency. Every serious investor studying this morning's price action needs to understand one thing with absolute clarity. What happened at 9:30 a.m. Eastern was not random market volatility. It was not organic selling pressure from nervous retail investors. It was a precisely engineered algorithmic execution, leaving a specific technical fingerprint on the charts that experienced market analysts have now documented across multiple decades and multiple asset classes. And understanding that fingerprint is the difference between panic selling your physical silver into a manufactured trap and recognizing the manipulation for exactly what it is. The strategy is called layering combined with spoofing. The bullion banks deploy what are technically described as layering algorithms that place massive sell orders across multiple price levels in the futures order book simultaneously. These orders are not placed with any intention of execution. Their sole purpose is to create the visual appearance of overwhelming supply pressure, making it look to every other market participant and every other algorithm scanning the order book that millions of ounces of silver are flooding the market from motivated sellers. Other trading algorithms read that order book imbalance and automatically initiate selling programs. Retail investors watching level 2 quotes see what appears to be a wall of supply and instinctively move to protect themselves by selling. The price drops. Stop-loss orders trigger in cascading sequence. And then, in the final milliseconds before those fake sell orders would actually execute, the banks cancel them entirely. The orders were never real. The supply was never real. The price drop was engineered from beginning to end. This is not theoretical reconstruction. This is documented prosecutorial evidence from the 2020 Department of Justice case against J.P. Morgan's precious metals desk. The traders executing these strategies were charged under the Racketeer Influenced and Corrupt Organizations Act, the same legal framework used to prosecute organized crime. The fine totaled $920 million. The documentation of exactly how these algorithms functioned was entered into federal court records that are publicly accessible. The specific chart patterns generated by these spoofing algorithms are identifiable, repeatable, and present in this morning's silver price action with textbook precision. What makes 2026 different from 2020 is not the strategy. The strategy is identical. What is different is the scale of physical demand working against the manipulation simultaneously. In 2020, the physical market was stressed but manageable. In March 2026, with Operation Epic Fury driving Asian physical demand to levels that are overwhelming normal supply channels, the algorithms are fighting a physical reality that is fundamentally larger and more aggressive than anything the spoofing strategy was originally designed to suppress. Everything discussed in this analysis ultimately converges on a single practical question that every investor watching this morning's price action needs to answer for themselves. When the paper system finally breaks, when the COMEX declares force majeure, and the fractional reserve illusion collapses under the weight of its own mathematical contradictions, what form of wealth actually survives that transition intact, and on which side of it do you want to be standing? The historical record on this question is unambiguous. Every fiat currency system in recorded history has ended the same way, not through gradual managed transition, but through sudden loss of confidence followed by a violent repricing of hard assets against the deteriorating paper currency. The assignat in revolutionary France, the Weimar Mark in 1920s Germany, the Zimbabwe dollar in the 2000s, the Venezuelan bolivar in the 2010s. The mechanism is always identical even when the specific circumstances differ. The currency loses credibility faster than institutions can respond. Hard assets reprice violently upward measured in the collapsing currency, and the people holding physical metal emerge with preserved purchasing power, while paper holders discover their legal claims are worth whatever the insolvent counterparty arbitrarily decides to settle them for. The United States is not Zimbabwe. That distinction is real and important. But mathematical insolvency does not respect national prestige or reserve currency status indefinitely. The U.S. government owes over $200 trillion in combined debt and unfunded liabilities against a GDP of $28 trillion annually. There is no historical precedent for that ratio resolving through anything other than significant currency debasement. The only remaining question is timing and velocity. And Operation Epic Fury, combined with accelerating BRICS de-dollarization and COMEX vault depletion, is compressing that timeline in ways that were not visible even 6 months ago. Physical silver in personal possession, or fully allocated segregated vaults, represents wealth that exists completely outside the counterparty risk chain that connects every paper financial instrument to the solvency of institutions that are themselves dependent on a currency system under terminal stress. It requires no bank to hold its value. It requires no government to guarantee its worth. It requires no exchange to settle its claims. 5,000 years of human civilization across every culture and every monetary system have consistently recognized its value independent of whatever paper system happened to be operating at the time. That is not an ideological position. That is the most important risk management calculation any serious investor can make in the financial environment of March 2026. The paper price you see on your screen this morning is the last gift the manipulation can offer. Physical reality is already telling a completely different story in Shanghai, in Mumbai, and in every coin dealer's shop, where premiums have not dropped a single dollar despite what the COMEX computers are currently claiming silver is worth. The vaults are draining. The premiums are diverging. The math is screaming what the mainstream will not say out loud. At the World Finance History, we do not chase paper prices. We track physical reality. And right now, physical reality is the most important investment signal on the planet. Subscribe, hit the bell, and share this with one person whose wealth depends on understanding what just happened this morning. Because the window to act on this information is closing faster than the COMEX registers.